Two stocks I'm buying in the next 2 weeks. The first one is a stock that I talked about many times. It's finally coming down. So I'm very excited to buy the dip on this one. And I think a lot of investors that missed out on the company could potentially research the sector, research the company, as its stock is down about 40% from its all-time high. The second one is a stock that I never shared before, and I'm very excited to talk about it and share it in today's video. So I really hope you enjoy it as always. The first stock is Ouster. Ouster is down about 9% on the month. It's down about 40% from all-time high over the last 2 to 3 weeks. It's been really, really bad for the stock, but the stock is still up about 58% year to date. And a lot of you guys found the stock through my channel at about $20 per share. I think the fundamentals have improved a lot since then, and I think the stock should deserve a higher valuation. So I'm going to give you my valuation and everything in this video. Ouster is the largest Western LiDAR and camera suppliers. They supply a lot of those sensors and cameras for industrial applications, for a lot of the robotics and humanoids, for a lot of the automotive sector. Although they're not too big in automotive, their main area is robotics and industrial. And they also are in smart infrastructure and in traffic monitoring systems, which is an amazing business for the company. So you could think about it as a picks and shovel play for physical AI, and anything that we've trained, all those models, they eventually have to be applied to real life applications, and all those models, they need to sense, they need sensors, and Ouster is selling the sensors. So it's a better to bet on those sensor companies than to bet, let's say, on who's going to make the best humanoid or who's going to make the best robot. It's kind of like betting on memory, but you know, you don't have to pick winners. You're just betting on memory, or you're just betting on Taiwan Sumi. It's kind of the same thing with Ouster. And Ouster right now is the only company that has the colored LiDAR sensors, which have recently launched over the last few weeks, and it's been a massive success for Ouster. Now, I talked about the robotics trend in general and the humanoids and all these things, and this trend is starting to pick up. More and more people are starting to look into it, but I still believe this trend is not being appreciated enough. If you look at this latest video of those Chinese robots, fighting each other in China, the video might sound a little bit funny and it looks like it's all over the place. But imagine how crazy this is and how unimaginable that was maybe 2 or 3 years ago. So imagine how good those robots are going to be over the next 2, 3, 4, 5 years. And this is an investor. His name is Jason. He's a very popular investor, actually. And he said a lot of things about the robotics trend. And he said that China is not doing this for fighting M&A. They're doing this because they're trying to arm those robots. They want to use them in war applications and a lot of the military and defense applications. And they're going to be much better over the next few years. And the United States is far behind China in robotics technologies, and intelligence in general. So the United States has to invest a lot of money to catch up. They were behind on drones. Now they're catching up on drones, but robotics, they're estimated to be a few years behind. So they have to catch up to China in robotics without using any kind of supplies, any kind of parts from China, which is very, very hard because you don't have a lot of those part suppliers in the United States. And Ouster is the largest supplier of those LiDAR sensors, and a lot of those companies like Anduril and other companies use Ouster LiDAR sensor. So the company is in a sweet spot, and I still believe this robotics trend is not being appreciated enough. The company has a lot of popular customers such as Google Maps. If you've ever seen all those pretty fancy images when you click on Google Maps, they're using Ouster LiDAR sensors. Same thing with Volvo, commercial autonomous trucks. Same thing with May Mobility, NVIDIA, and Serve Robotics also uses Ouster LiDAR sensors. And even Amazon has warrants on Ouster. Those warrants will convert into equity, so the company will own a piece of Ouster in the future. But also a lot of the robotics in the Amazon warehouses, they are using Ouster LiDAR sensors. So the company is a $2 billion market cap, but it's much more, you could say, it's much bigger than you think it is in terms of all those companies that are using Ouster. Now, when I first talked about the company, the main question I got is, what is the moat? Any company can manufacture LiDAR sensors. All those LiDAR sensors are the same. So therefore, Ouster has no moat. And I said, if Ouster had no moat, then why is the company putting up 49% gross margins? For a company that has no moat, they would maybe put up 5, 10, 15, 20% because they can't really charge much more than their cost of sales because their competition is killing them. This is not the case for Ouster. Their gross margin is about 49%. And this is for a good reason. The first one is they have a technological moat. They are one of the few companies right now that have those colored LiDAR sensors. Other companies are far behind in this technology. So they do have a technological moat which allows them to command higher pricing. But they also have, you could say, a sovereign-related moat because they are based in the United States and they're the largest US supplier of LiDAR sensors. Because the biggest risk for those kind of part companies is always the cheaper alternatives, the cheaper Korean alternatives, the cheaper Chinese alternatives, and that's why those companies don't succeed. But in the case of the sensors, this is a critical area where you can't use Chinese sensors because your data could be shared to China. If the robots or traffic monitoring system are monitoring traffic, this data could be sent to China if they're using a Chinese LiDAR sensor. So this is why, for example, the United States government has banned Hesai and they put it on the blacklist for working with the China's military. Hesai is the largest supplier of LiDAR in the world. It's very profitable, much bigger than Ouster, and they have very high margins and a very advanced technologies. They can't be used for any Department of Defense and most critical applications because they deemed it as working with the Beijing military. So we just eliminated the Chinese competitions from some critical areas. But there's even a bill which could pass as soon as January 2027 that would seek to phase out Chinese LiDAR from all self-driving cars, and all the cars that you see, most of them have cheap Chinese LiDAR. Well, the United States government wants to phase them out because there's fears they could be hacked from space. So this is a national security bet as well, and this is why Ouster is putting up about 49% margins. The only thing that those two parties agree on is the China issue, and none of them wants to put China in front of US companies, Democrats or Republican. So, that's a sweet spot if you ask me, and Ouster is playing in it. Now, the company is still unprofitable. They're expected to be profitable by about late 2027. They'll be losing less and less money on a per share basis, which is very good for the company. Now, a reason why the stock has gone down, other than the overall market, you could say, and risk appetite not being as great as it was before, is mainly the company raising money. So they did an offering of about $200 million at about $55 per share. A lot of people were very, very upset that Ouster was, you could say, diluting shareholders at $55 per share. But I was personally a very big fan of the offering. At $55 per share, which is, you could say, from 55, now it's down about 32%. The stock was trading at about 17 times sales. 17 times sales was very excessive for the company, and the company took advantage of it by raising $200 million. Now, this $200 million, a few weeks ago, when I was buying the stock at the $20 range, it would have costed shareholders about 18% of the company. But because they did it at $55 per share, at a very high valuation, which was about 20 times sales, it costed shareholders about 8% of the company. So they got access to $200 million at a much cheaper cost of capital than they did a few weeks ago. And this is what smart management team do. They buy back the stock once the stock is cheap, and they potentially look into issuing equity if the stock is extremely, extremely expensive. And now the company could literally just take the money and buy back the stock, and they would create about 32% worth of value between 2 weeks ago and today. So what they did was very smart. I like what the company has done. Right now, Ouster will have about $400 million of total cash and no debt and profitability next year. Now, $400 million of cash is about 20% of the current market cap. Is just sitting in cash with profitability on the horizon. For me personally, I was a very big fan of what the company has done, even though it tanked the stock in the short term. But I'm in it for the next, hopefully, 10 years or so. Now, for the company's guidance, they're guiding 30 to 50% annual revenue growth for the next few years. I think personally they can do it for at least 10 years, potentially 40 to 50%, because they're starting from only $170 million in revenues. Hessa is doing like 2.2 billion. Ouster is doing 170 million, guys. So we are just beginning in terms of the industrial LiDAR applications and industrial automation. 170 million is nothing. I think they can grow it at a much faster pace than 30 to 35%. But for my valuation model, I put in 170 million for the next 10 years at a 35% annual growth rate. Again, I think it could be 40, 45, but I'm using 35 in this case. I get about $3.4 billion in revenues 10 years from now, which I believe is highly likely. Now, we look at the company's current valuation. It's now trading below 10 times sales, about 9 times sales, as high as 16 times enterprise value to sales, now trading at about 9 times sales. So we take the 3.4 billion and we're going to make two assumptions. The first assumption is that Ouster trades at the same multiple it's trading at today, which is about 10 times sales. We get 3.4 billion, we time it by 10 times sales, which I personally believe is highly likely. Now, in this case, we get a $34 billion market enterprise value. The current enterprise value is about $2.2 billion. This is about a 14.5x over the next 10 years with a company like Ouster. That's not bad at all. But let's assume the company doesn't trade at 10 times sales, but instead it trades at 5 times sales, which is a much more conservative case scenario. Now, in this case, it would trade at about a $17 billion enterprise value. The current enterprise value is about $2.2 billion. This is about a 6.5x over the next 10 years with a company like Ouster. So I believe Ouster today is really not bad if you have a long-term horizon and if you want to potentially start a small position and dollar cost average down. But for me personally, I've been telling a lot of people that Ouster, like low 30s to under $30 per share, is like the sweet spot. I have it under $28 per share. But I think with the recent raise, I would say, under $32 per share, under $30, it will get very interesting. So I'm planning to potentially buy the stock around $32, under $32. I will be a buyer because I trimmed some of my position in the high 40s. So I'm planning to buy it back under $30 per share. Now, the second stock that I never talked about before, and it's actually might surprise some of you, and this is an ETF. Now, I personally haven't bought an ETF in 7 years. I'm not an ETF guy. I like buying individual stocks, betting on specific companies. But in this case, this is an ETF that I just discovered a few days ago, and I like it very much, and I'm going to tell you why. It's down about 9% on the month. Now, if you look at the ETF's metric from Morningstar, it's trading at about a 12 times earnings, and it's expected to grow about 15% earnings per share over the next 3 years. This is from Morningstar again, so it's a highly reputed firm, and I think that's really cheap for the ETF. But in terms of what's inside this ETF, is you're getting Taiwan Semiconductor, about 24%, you're getting Samsung at 15%, and SK Hynix about 4%. All in all, in total, you're getting about 45 to 43% of the ETF in those three amazing companies. Now, why do I like those companies very much? It's not just because they're cheap, although they are cheap, but I personally like the physical assets in general. When I buy a stock, I like physical modes, physical assets. I like them much better than designers, although I own Qualcomm, but I also like a lot of the physical asset. Those companies are like the picks and shovels. They're kind of like Ouster. You can't really escape Taiwan Semi. You can't escape Samsung. You can't escape SK Hynix. And I'm getting all of them in this one ETF, which is about 45% of the total ETF. And I like that very much. I could personally buy all the three of them and keep up and do all these things. But I'm getting all those three together in one ETF. For me personally, that's amazing. With Taiwan Semi trading at 24 times, Samsung at about 5 times, SK Hynix at 6 times. Now, in addition to those companies, I'm also getting Tencent and Alibaba. Now, I personally believe that a lot of those open source models will be coming out of China, and Tencent and Alibaba will likely have something to do with it, maybe in terms of compute, maybe in terms of owning equity stakes, kind of like how Alibaba acquired a percentage of DeepSeek. So I'm also getting exposure to some cheap Chinese companies, and I personally don't mind it at all for owning Alibaba and owning Tencent in this ETF. Then I also get MediaTek, which is also a designer. It's been growing rapidly in terms of chips for automotive and personal devices. And I'm getting DBS Group, which is a very large bank in Singapore. And I'm getting some pretty amazing companies, but about 50% of the ETF is in what I would call those physical mode companies like SK Hynix, Samsung, and Taiwan Semiconductors. So I'm personally, looking into potentially buying this ETF and just hold it for the long term as my semiconductor exposure, you could say. It's AIA. This is the ETF. The expense ratio is like 0.5%, but I also get like a 1.5% dividend, which offsets some of the cost. So 0.5% is not really crazy for this one. I'm personally looking into buying it. Like if Taiwan Semi gets under like 350, 340, then I think this ETF will look very attractive and I might potentially buy the ETF. And maybe I'm even gonna maybe buy Taiwan Semi, but I personally like having Samsung and Taiwan Semi in one ETF. I couldn't find another one, so that was my best find for such exposure. And I just wanted to share it with you as a potential idea if you like it. And if you're interested in getting, to know when I'm buying something, when I'm selling something, a lot of my robotic stocks outside of Outstore, because I'm betting big on this sector, I share everything I do in my group, and this is the link if you're interested. But thank you very much for watching. Hope you enjoyed it. It was not financial advice. Some of you guys want me to say fashion advice, but I'm saying financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.